A mostly lower day on Tuesday with the exception of live cattle futures. Joining us with an analyst, Ted Seifried with Zaner Ag Hedge in Chicago. And thanks for being with us. And the grains, well, lots of red on the board again. We have really been caught up in the risk-off environment from the outside markets, and there's so much concern about what the Fed is going to do here with rates this week, right?
Yeah, absolutely. And when we have days like today, when you have stock market sharply lower, and you call it risk off, and that is an accurate reflection or accurate term of what's happening. But I think it's a little bit more than that, Michelle, because what this is sort of an inflation off move, or at least that's a concern in the stock market. And in an inflation off thing, it can be a much bigger deal when it comes to grains and commodities as a whole, because commodities are very sensitive to the idea of inflation. In fact, I'm willing to say that a lot of the pricing that we see on the board in any of these commodities, there is a large inflationary component that is built into these prices. And if you take that component away, you've got a lot of downside potential, even with the same or even possibly even slightly more bullish fundamentals than what we're looking at today. So for the most part, we want to trade grain fundamentals. We want to trade weather. We want to do the things that we normally are used to doing with these markets. But at the same time, you have this 10,000-pound gorilla in the room, which is inflation. And you've got the stock market that's lost over 20% of its value since the beginning of the calendar year. You've got the cryptocurrency market that's in an utter meltdown. And the amount of wealth destruction that's happened there is now added up to be more than what we saw in 2007 with the subprime mortgage bubble burst. So these are all very deflationary things, and eventually will really go a long way to popping that inflationary bubble, along with the Fed raising interest rates. You hope that the Fed doesn't get too aggressive raising interest rates, because I think a good portion of this inflation is sort of fixing itself with that wealth destruction that we're seeing in the stocks and in the cryptocurrency markets. And it's tough, Michelle, because on a day where it's 100 degrees, you say, well, maybe corn should be 20 cents higher.
Right.
At the end of the day, you're saying, oh, corn was only down a penny. It did the best of anything on the board. Well, yeah, I mean, because we are still trying to trade a little bit of weather, but there's bigger things, and you don't really know on any given day what we should really be looking at or what the markets are really looking at. You got to kind of look at it as a whole. And since the beginning of the year, I'm going to say that we've kind of ignored the weakness in the stock market and cryptocurrencies. Just recently, it's become a much bigger factor because, again, we're wondering, is this an inflationary bubble burst? And if that is the case, then we've got some repricing to do in the grains markets as well.
So I'm curious about soybeans. Of course, we had new contract highs just last Thursday. We've had over $1 correction or about that amount in the July contract. I don't know, technically, are you concerned about that market?
You have to worry, with a close below the 20-day moving average, which is also, pretty representative of trend line, and with a close below the psychological support level of $17. You got to worry a little bit about that chart, but also, I don't know if we're trading a whole lot in the ways of technicals right now, because, if you go back to last Thursday with a new contract high and a new contract high close, that was really suggesting that we were going to go test those all-time highs in a hurry, and probably break through them and really continue on to the upside. But then you have these other things happening, macroeconomically, that completely throw the technicals out the window.
But the demand hasn't changed. The demand picture is still the same.
Well, I mean, the old crop soybean story of, hey, we're going to have a real thin, tight ending stock number by the time we get to the end of the marketing year, that hasn't changed at all. We continue to see export sales numbers above and beyond what we really should have, in order to kind of, make sure that we have enough soybeans by the end of the marketing year. Your domestic end users have to be getting a little bit concerned. We've heard that China's, 30 to 40% booked up for August, meaning they've got a lot more to buy yet. So yeah, you have this bullish fundamental scenario, but then you've got other things happening. Again, big slide in the stock market Friday, Monday, Tuesday. And again, that causes that risk off or inflation off trade. So again, we're just kind of juggling everything. I really do think if we can get a recovery in the stock market, we'll go back to what we were doing into Thursday of last week. I think there's good reason to say that soybeans can and maybe should go make new contract highs, as long as this, again, inflationary bubble burst is not happening in earnest just quite yet.
Right.
So once we see what the Fed decides, if we get that recovery rally in the stocks, which I think there's a good possibility that we do, as long as the Fed doesn't something that's completely out of the realm of everybody's guesses, well, then I do think that we'll see the true colors of the soybean market and even the corn market as well.
Absolutely. Corn probably got a little spillover negativity from the wheat market today, but wheat is at harvest pressure. Are we starting to see that come into that market?
Yeah, it's that time of year, Michelle. We are harvesting we're moving with that. I mean, we've got a pretty open harvest window here. And so as that cash is coming to town, that's going to provide some pressure on the market. And it's going to be noticeable pressure when you're up at these elevated price levels. However, what I am going to say is that in a year like this, where we have really rather poor yields, a much shorter crop than what we were thinking when we were planting, a lot of that harvest pressure, it happens in the front part of harvest. And generally speaking, on a good harvest, we expect harvest pressure to go 60 to 80% of harvest, and then really tail off, and then we have what's called the harvest low, and we start to come back after that. I think that happens earlier in a year like this because I think there was a lot of those contracts that have been sold. So really, what's coming off the combine or what's coming off the harvester right at first, that comes to market, that goes to town, that puts pressure on the market. But by the time we get about 40 to 45% through that harvest, I think that harvest pressure really falls away,
Okay.
and that leaves us open for recovery, balanced recovery rally at that point. But again, that really kind of depends on what's happening in the great macroeconomic scheme of things and what's happening with the row crops as well.
Right. Let's talk about the macroeconomics and the impact on the cattle market, which is usually negative. Cattle came back nicely on Tuesday, and we did have some higher cash trade out in the country, but were we also putting in maybe a little weather premium in that market?
Yeah, you have to put a little weather premium. You got to wonder what this really warm temperature is going to do to weights. You do want to say though, on a day where it didn't seem that we were trading really any of the individual market fundamentals, we were trading all, what's happening with stock market, crypto, and everything like that. You got to be pretty impressed with the cattle. That was a good sort of stability game, right? We weren't sharply higher, but we were higher and kind of stabilizing after the concerns that we had about demand and the slide that we've seen in the previous couple days. That higher cash trade did help. The weather did help. And you got to say, if we see a stabilization in the stock market and we can start to not panic so much about what the domestic demand is going to be in the next few weeks, you can really kind of hone in on those individual market fundamentals and say that there could be a recovery rally coming for the cattle. I'm optimistic. I've been very optimistic about domestic demand despite the higher prices that we have. It seems to me, Michelle, people are still spending money. I see lines for people trying to get into restaurants around me. People are driving. They're out and about. People want to live like it's 1999 because it's been a while since we've had the opportunity to really be unrestricted. And I think that'll carry on until, say, about midsummer. After that, I get concerned because, we typically see the summer doldrums into August where things start to slow down as people realize they've spent a fair amount of money, they've had their fun, and so on and so forth.
Right.
That could be profound this year. But until that happens, I still think people are buying. I think that domestic demand is going to stay very good, keep packers' margins at a reasonable level to allow that cash trade to be higher.
Hog market, we have basically been in a consolidative pattern. Are we going to stay that way?
Yeah, the hog market's a little bit frustrating for me because you think if the market's so concerned about demand for high-priced beef, well, okay, you go to your grocer's counter or your butcher's counter and you see, oh, there's a 1 pound ribeye for $24. That's really expensive. I think we're still paying it. But if the concern is that we're not going to pay that, well, you don't have to look very far to the left to see, hey, there's some really cheaply priced pork products right there. If we're worried about inflation and high prices really hurting demand, then what about the cheaply priced pork? Aren't we going to see a flood of this demand move over to pork? So I don't know. I really do think domestic demand is going to be rather strong. I'm looking for a recovery rally in the pork. I think the pork or the hog market is a nice value opportunity for those that are scared that demand is going to falter because of these high prices.
Okay, well, I appreciate your time as always. Thanks so much. Ted Seifert joining us with Zaner Ag Hedge.